This is a video about reserve-based lending, but it's really a video about debt repayment, about debt sizing, about maturity of a loan, and about LLCR, PLCR, and FLCR. So if you haven't opened the video, obviously you're not going to open the video, but it's to understand reserve-based lending, which was completely intimidating for me. I thought, oh my God, I used to hear about this stuff. What does it really mean? I was like other people. I pretended, oh, okay, I can get this, I can get this. And until you go through and make a little model, until you go through a term sheet, understand what they really mean, make the mechanics, then you can see, it's not that bad. So what I'm going to do here is to kind of change some of these parameters and see, what happens if we change the size, change the size of the loan, and then you have to kind of fix the size of the loan, and what happens to the ability to repay the loan, and what happens if you've got low oil prices and you have a little default here for the CFAVS versus the cash flow, or even if you do some kind of break-even analysis and you see, well, how low can I go until I can't pay off the loan? Okay. And it's not really shown here very well, but we'll walk through these kind of issues in the analysis. That worked. I was just making sure our scenario little button would change the oil price. I was a little bit afraid of that. Now, to start with this analysis, I'm going to go to a page called the financing page, and I have no idea what's on here. Did we color it? Okay, we're going to walk through this page in the model. Again, it's an annual model, so don't complain and say, oh, you didn't do all the fancy little crap. Oh, so what? And then I'm going to start by explaining some of the. Okay, I just want to tell you something at first. God, this is in the morning. I'm sorry. I had problems. Whatever. That I've got to get some words out here. Okay, I'm gonna edit the video on that one. Reserve-based loan begins with reserves, okay? And so here's part of the term sheet that you have to deliver the reports by an independent engineer. And what I'm going to do when I'm finished this, before we look at our model, we'll look at some examples of reserve reports. Okay, and then when they deliver the reports, the modeling bank prepares a projection, and you have to agree on things like discount rates and oil prices and gas prices, because the reserve reports are driven by how many reserves you have. And I've got here, this is a little graph of some oil production over time, I guess, or total in barrels of oil equivalent, rather. So I remember when I was a banker a long time ago, I didn't ever admit that I was. Maybe I did. We used to use 6. So if you have, I think it's MMCF of gas, or is it MCF? Whatever. A 6 times the gas equals the oil. I can't remember if it's MMBTU. Frankly, sorry about that. And then what we want to do is make a little thing where we push the oil price down. Now, the amount of the loan, in any loan, you can separate a loan and figure out You can split the loan into various drivers or various parts, and the first part is how big the loan is, and then the next part is how you repay the loan, or how you draw on the loan during this availability periods when you draw the loan. Okay, so in this case, it's only a 6-year loan, and there can be a reserve tail, and if you've taken out the reserve much faster, then you have to pay off the loan even earlier. Okay, and the amount of the loan here is really determined by something called the borrowing base. And here is the deal. The borrowing base, which is driven by the reserve reports, drives the repayment and the size of the loan. That's the trick. Understand that, and you got everything. So in our model, if we go to the diagram page, here, this is the reserves, and this is the value, the net present value of the reserves, and the loan follows the net present value of the loan, and the repayment of the loan as you go down, 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 down here is driven by the production of the oil or the natural gas. Okay, that's not so hard really, is it? And then you have to define the reserves, and the reserves are defined by something called an FLCR amount or an LLCR amount. Now, I haven't done this enough in videos, but when I have kind of a discussion about this, and then it says down here, you can never exceed the borrowing base. Before we do that, before I go to the little illustrations, here you also have to, I don't know why I put this one in, you have to, the company can decide how to hedge oil prices. I would think the bank wants you to hedge as much as possible, obviously. And then you have a DSCR covenant, like kind of any other loan. And this is where it gets a little tricky. You compute the field life NPV, and it's the field life of the CFADS. Now, for the LLCR and PLCR, you use a discount rate, and the discount rate has to be the debt rate, and it should be the debt IRR if the interest rate changes over time. That's a little bit of a tricky kind of business. Okay, or if you, it doesn't have to be the debt IRR. You can do this compounding, some product of the CFADS divided by the discount factor. And then you have a loan life NPV, which is similar to the field life NPV, but it only takes the net present value based on the up to facility termination date. It cuts off the end. You have two different present values. These present values, I'm restating, they are not exactly the same present value you use in LLCR and PLCR. And then you have the facility amount, okay, which is the borrowing base, basically, and you take you have an FLCR amount, LLCR amount, and you take this NPV that you computed, and you divide it by something. Now, when you think about this, here, let's take 1 divided by 1.4, and you get 0.71. This is like, I'm going to even put this is like a loan to value. I can't do that, shoot. I have to insert it. Stupid textbook. Okay. Like loan to value of 1 divided by 1.4 equals what was that, 76 or something? 714. Can't remember anything anymore. So what they're basically doing, this is almost, you could now make it analogous to real estate or something. It's like a loan to value. The amount of the loan is 0.714 of the NPV, and the NPV has all these assumptions in it. And I repeated that one. Okay, that was pretty stupid. Okay, and so now let's work through this and show you how it all works in a financial model. And that's almost enough. Now, before we do this, I have this little reserve report. And what's not in the, they don't put the assumptions in here. And what's amazing to me, this is just so amazing, they still use a 10% discount rate, which is the same discount rate they used when the interest rates were probably in the 80s, and the same interest rates before the financial crisis. And you can see they get the total. This is a reserve report again. The total NPV of the post-tax revenues. So they'll compute up here the total gross revenues and the post-tax revenues, and down here they compute an NPV of all the revenues, and that depends on the oil price and the reserves in the ground. And let's make a little graph of this. How's that? I don't know what's going on here. Maybe I'll stop here. It's got some negatives. No, there's abandonment cost, I'm sure, which that's kind of interesting that ooh, that's a funny kind of thing. I don't know, maybe some fields go down, and then this is kind of a decline curve, and that's how you'd get the reserves. To show a little bit what's going on. They have the production first in the different years, and on and on and on. Okay, so that's the reserve report. They use 10%. Now, if we want to then convert that to our model, I'm going to have to make a little adjustment here, but I'll do that right now. Okay, up in the excuse me, in the assumptions. So we put this FLCR. I'll put this 1.4 that was in the thing, and I put a base one in. I think I went through this before, but these are range names. You see, it says base FLCR, and this one says base LLCR. So if you compute the reset of the financing, it will just take you back through this. And I hope I have reset. This is where do I have the reset of this one? I don't know. I'm not going to worry about that right now. Okay, that's a little macro that will set these numbers that you're using. Okay, I hope yes, of course I changed this one. Okay, and we can get different sizes of the loan. It's almost like I think it might be good to just put these kind of loan to value ratios. Okay, this is like a times, and the next one we can say is like a loan to value. Okay. All right. And so if I put a higher number in here, then we get a lower loan to value. The value is the reserves, and that's really what you're doing, and that's what I'm trying to explain. And then you can have a tenor here. Now I put different tenors depending on what the loan size is. I don't think I mean the reserve life is, excuse me. And I didn't put the reserve tail in. I should have. Excuse me for that. I didn't put some of the commitment fees in yet, but that's all right. And then we take those assumptions in. You can fill in the commitment fees if you're really worried about that. Okay, and we get, here is the big deal. We get all of our operating data, and I'm going to restructure this just a little bit. No, that's good. Why not? During a video, if I had some crappy things in the original one, I should put that in. And I think we really should start with how much cash flow do we get from the construction, and then we can put in our loan life, and then we should get our borrowing base. I think we almost should do all of that first, and I better add a couple of lines down here, otherwise I'll start swearing, okay? And I don't think that's that bad to do this in the video because it's such a crucial part of what we're going to do. So we get the cash flow from the production and the cash flow over the loan life. I suppose we better put our flags in there too. And then we put our smaller of the loan life or the project life. Now, actually, what I'm just doing for me is a really serious issue. It's something I get very emotional about. Okay, and I think that should be not. I'm not getting emotional about this. Okay, putting a title in and coloring the sheet. Okay, well, I do get emotional other times about that, but not this time. Okay, what I get emotional about is the structure of the sheet. And in the structure of the sheet, I'm just pressing Control C to class just now. He said, no, it's colored shit. Okay, I have to work on this resetting of the language and all that. Now, so we start with the cash flow from the production of the oil. Okay, and that is right here. We start with, and this comes from the reserve reports. I'm trying to get some of this language out of my mouth. While I'm doing this, I'm going to take a break. Shift Control C. Let's color this a little bit better. This should have been colored. Of the loan depends in large part. This kind of crap. I just. I'm gonna do this one too. Excuse me. I'm gonna color this one too. Put the value of the loan depends on the discount rate you put in, and so we go down to the financing assumptions, and we have this discount rate. I should have put that in. With a 10% discount rate, you're going to get a lot lower value of the reserves. If I was the oil company, I'd say, "What are you nuts? If I lock in some reserves with hedging with a discount price, here's how you should really value how you can. It's called risk neutral valuation. You put in a hedged oil price, and then you say, okay, I'm hedging, I'm getting rid of the risk of the oil price, and then my production I'm pretty good at. I've heard from the pretty experts, at least one, who said, oh, they're pretty good with these production estimates. So that risk is pretty low, especially once you've got an existing field. And then you put a risk-free rate almost in there because you've taken all the risks out. 10%, what a ridiculous kind of rate. And then you start it's really, you take the NPV of the future. So this NPV, this is after the construction period. This is the NPV that's our initial borrowing base right before we start. That's what we're going to use to repay the loan. Okay, and we can do the same thing now, go over instead, take the NPV over, we first put the cash flow. This is the total cash flow. There was another video I did to say how you get the revenues from cost recovery and your operating expense, blah, 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 your bonus payments, your income taxes before you accounted for the deduction in the taxes themselves. This is your revenues you get. Okay, and you take the PV of those revenues, and this time I took the amount of cash flow, but multiplied it by a one, or the debt repayment flag, and I put a little thing here. Okay, and Control Alt C to color it comes from. So. I have to maintain this damn thing. Okay, so the red, if it's red, it came from a different sheet. Okay, now God, I hate editing these videos. Okay, so then you can take the maximum of the line. That's I'm excuse me. We take this NPV of the reserves and then we divide it by this factor, and we get the total loan life, and the loan life is the maximum of the whole thing. Okay, and now we're going to have to fix this debt in a minute. If I press fix debt, that's gonna we're gonna take this thing and compute it and fix it, because later if we want to change something like the oil price case and put a lower oil price case, we'll get a lower value of the reserves. But what we did is we computed using kind of a financial model before the oil thing starts. We got our estimate of reserves, and that's how we set the oil price. And then this product this blah 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 this borrowing base, as it goes down, because you have low oil prices, it doesn't mean the initial debt went down. You set the initial debt at the beginning. So you do need a little copy and paste things to get started. Excuse me for that. Okay, and then we do the same thing. We take the NPV of the future reserves and we get the maximum amount here. And then and right now it's if we have a higher if we have this loan to value, which is lower here than this, we got a lower borrowing base from the field life than the loan life, and so that determines the minimum, determines our debt. And here's my philosophy about all of this. Why in the hell would you not put this at the beginning? You don't, God damn it, you don't put the stupid thing where you put development, construction financing, follow a blind little blah, 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 blah. You start with how the loan size works. How could you not do this? I didn't do it correctly. And now it starts to make sense, because then you put a sources and uses, a fund statement in, and God, I shouldn't have got this emotional. My nephew who says I goes on a tirade and says I'm the biggest asshole in the world is probably right. Okay, you put in the capex, and then you see how much of this total loan that we fixed is financed. That's standard kind of project finance, and then you make sure that the sources equals the uses, and then we take and delete all this stuff that I just had talked about, and then we put our debt balance in, and with the debt balance we say, okay, well, let's start with the opening balance of the debt. That's the from the the debt account. And why in the hell this thing, we had some kind of thing here. If you press Control Alt C, what you can do if you have the same sheet name, and I can't stand it when the sheet name is the same, you press this thing that says remove links to the same sheet. I'm going to do that. I'm going to have to turn off the video because it takes a minute or so to do that. Little thing in there that takes you back to where you started. Hopefully these are all from oh, these now, see, I had it wrong, so I have to press Control Alt C again. Excuse me. Oh, God. And I think all the parameters are just fine now. And now we don't have those red things going on anymore. That was really important to get the color right, isn't it? So these things, it doesn't have the sheet name, it just takes the sheet name out. So we're back, opening balance. This shitty video, sorry about that, but whatever, I need to make one. Then this is the borrowing base, and the borrowing base is up here, L131, and that's the borrowing base, and that's the smaller of the amount we got from the loan life or the field life. Okay, and if that goes down, if the borrowing base is less than the opening balance, guess what you have to do? You have to pay it back. And so that just says, well, let's take the difference between the top minus the second one, and then we multiply it by L21, which is the repayment flag, which I should have kind of moved, whatever. I should have, but should have put another one in, blah, blah, blah. That can't be negative. You don't have a negative repayment. And that says how much repayment do we need because our borrowing base went down, and that's the key. And then you can have some other kind of make sure you have a fixed repayment in to pay back by the end of the loan life also, which I didn't even bother putting in. I just wanted to focus on the repayment from the reserves. So here's our opening balance, and then here's the amount that gets repaid from the decline in the borrowing base. Then our opening balance goes down. And now if we change it to the low oil price case, then we have to start paying a lot more. And we might have a default if we don't have enough cash flow to pay that. That's the big deal. I can't understand why you wouldn't put this in this kind of possibility of a default in the models. Or if we even put a really low oil price in, if I put a really low oil price, we can start doing a break-even analysis. Now this, I hope you see why you had to fix the first one. And that means we have a whopping repayment because the oil price suddenly went down, and that meaning our future reserves are going down, and you get the next reserve report, blah blah blah. It would change the amount of the reserves as well, and all that stuff. And that's the repayment. Let's put it back to the base oil price for a minute. Okay. And then we put interest rate standard stuff here. I was explaining to the people in the class when we did this that it's always the net present value of the future repayments, the debt service and the interest is the same, and there it is. It's the same as the balance of the debt. Okay, now I'm going to come back to that in a minute, and then we can have a defaulted debt. So what happens if we put a low price in? I want to model the default, and I want to model the interest on the default, so I can see just how low the oil price can go before we can't pay off the debt. Now, I really didn't know what to do with this one. If I put this debt balance in, and I think that's got the default plus the regular loan, I think this one kind of should be in the diagram page, and I just didn't know where to put it. You know what I'm going to do? I'm going to make a tiny little one here. Does that suck? I don't know. I got yelled at. I'm not an artist. Sorry about that. I'm a bad investment banker. I'm a bad artist. Whatever. I was told that just today. Okay, and let's make this a little bigger. And what we can do then, I don't know if we'll be able to see this. Can we just about see this? If we put, let's put, there, see, we can see just how low, well, if the oil price is zero, that's pretty bad. What kind of oil price we need for this to just break even on us not to be able to, I didn't want that, not to be able to pay the loan off by the end of the reserve life. So instead of this, let's put 1 and just do kind of a break-even analysis and keep pushing it down, pushing the oil price down. And when I just push it down, there, we can't pay it off. Is that right? Can we not pay it off? I need to compress it a little bit even more. Okay. Maybe I'll even just take this. Take the scale out. Is that artistic? And then move this over. Okay, so if the oil price is 28.6, it doesn't work. If the oil price is 27, it doesn't work. 28, 29. Then it worked. The other thing I think I really should put in here is I think I should put these things. If I would say, okay, I want to be a little bit safer, I'd put this up, and then I'd fix the debt. Oops, let's put the base case back in. I thought last time it worked. I'm going to pretend that we set the oil based on this, and we fix the debt. And now we're going to put a much, much lower oil price in. We'll leave all the rest of the assumptions the same. And if it's 31, it doesn't work. If it's down to, I'm sorry, if it's up to about 32, then I'm looking over here and it did pay off. That's what you can do. That's, for me, the kind of modeling. Now, if I would have put, instead of 1.5, if I would have put 1.3 in here, clicked on the downside case, I guess I have to click back to the base case. That's our initial thing. And then we're going to fix the debt. That's that thing I just showed you where you take the borrowing base right at the beginning and you fix it. And then we go and we put oil price in, and now it's not paying off. So now we have to put a higher price in because essentially our loan to value was a higher loan to value. And then we need something like a 37 oil price. So that's what I would want to see. I know I'm not claiming I'm any kind of expert at this field or anything else, please. But I want to show you some modeling ideas out of this. Okay, I'm just putting the base case back in. Excuse me, and I'll just in case, I'll fix the amount of the debt. Why does this happen? Just a minute. Okay. Oh, now we have the same ratio, so it gives you the same value. Okay, and maybe I don't know how to do this. I want to put the debt to cap, and maybe I want to put the loan to value. Okay, it's related, but not exactly the same. Okay, and maybe I better put this to get it a little more artistic here. Okay, so let's go back to our model and I'm going a little bit unstructured here. Excuse me, FAST. I'm not being structured, but I'm being flexible. Okay. So that's really in the financing. That's what you want. Now to set this little default table up, it should take minutes. And don't be afraid to put a default table in. Don't be, oh no, the bank's going to see a default. I want to know the default point. And to do that, I need to put one of these things in, and I want to know if we can repay it. And you just put an opening balance, closing balance like you do anyway. You go through all the CFADS, and then down here, if the cash flow is negative, so we're going to put a low oil price in, and I'm going to push it down a little bit. That's really low. Then, we get this gigantic default. That's too big. Let's have it somewhere here. We have a default here, okay, and that's just used with the maximum function. But once we have a default, then it's not so bad. We have positive cash flow, and we use that cash flow to repay the default. And that's cash flow is up here. So what you do is these default and repayment of default comes downstairs from the cash flow waterfall, and then you don't forget to put the interest, by the way, on the defaulted debt in there. That's somewhere here. Okay, good. And then this repayment has to be a max and a min, because once you have repaid the total default up here, then you're finished. And then once you have that default balance, which is how much is the opening balance and all that, you add that to the closing balance of the debt. And then what we do is we just push this down. I'm pushing it way too much down. And now we can never repay the default off. And that's what we're graphing. We're graphing this closing balance of the default plus the basic default balance. And then we can compute DSCRs and all that stuff. And for our covenants, big deal if the DSCR is really, really low because the oil price goes down. What are you going to do? So that's, for me, those are the key issues with reserve-based lending. It depends on how you value the assets, and the size of the loan plus the repayment of the loan is driven by the is driven by the reserve report. And I have a little other, I want to just make one little more point, and that is I put a fake downside case with some methanol price and all this. It's just got a flat price. Now, if we look at DLCR, PLCR, LLCR, DSCR, it's a little bit different. When you compute the LLCR, you don't use when you took the net present value of the cash flows. Let's go down to this one, and I obviously need to make my generic macros. And if you're yelling at me about this, tough shit. Because I want you to stop wasting your own time with your silly coloring. Okay, and then you can go down and get the PV of the CFADS. But when you do the PV for the PLCR, and I always do the PLCR first because it's a little easier, you use the interest rate on the debt itself. Somewhere up here I must have put the interest rate. Shift Control P to really show it. Okay, and you compute the present value of all of the cash flows, and then you divide that by the debt. Now, in this analysis, I also did one of these nifty little default things to illustrate. So we have a default and repay the default. Now, just like with the oil price, I'm going to put the methanol, not methane price down. And when I keep pushing it down, I hope you're looking at this one first. Eventually, and I have just a flat repayment, eventually the DSCR goes just about to 1. And you can say, aha, that's the break-even price. Because if the DSCR is, that's a little, maybe, it's somewhere between that. When the DSCR is that, I can't, the methanol break-even is below that. I have a default here. Let's have a default. Now, if you have a default, you would have seen a tiny little increase in this one. I couldn't see it. But we're still paying the debt off by the end of the loan life and by the end of the project life, because this default is repaid over here. Now, if I keep pushing it down, and I have no idea, the loan life must have been 12 something here. Why did this silly thing, if I keep pushing this down, eventually there's more of a default, and eventually it goes up. Oh, that's my alarm clock. My alarm clock. Gotta get up. See, I'm doing this in the morning. Okay. And then I keep going down. Now, eventually, right now, I think right here, we just couldn't pay the debt off by year 12. That's why I try to get this in. If we push it up, then we can, and the defaults here, plus the interest on the defaults, are matching the cash flows here, and that's what the LLCR measures. So the break-even price for the LLCR is this, but we still have this big tail, which is what the PLCR measures. And you keep pushing it down and pushing it down, and you have to use the discount rate in the NPV as the debt amount, or it doesn't work. And I'm going to keep pushing it down until I get to year 25. And when I get to year 25, the PLCR should be up. It's getting close to 1. Below 1. And when that PLCR is 1, you can't pay the debt off. You can just pay the debt off by the end of the life. And the discount rate, I'm repeating it, has to be equal to the discount rate has to be equal to the debt, and you can adjust it. I've gone through that in different videos, but I just wanted to go through this concept, this FLCR and LLCR that they use in production payment analysis, because it does not have the same discount rate, is not the same as the normal kind of ones we see. I'll just press the reset button. Okay, and this reset button, I should have done that with the other one, is just a little thing where we set the price back to the base price so we can use all of our little things. And that's enough of this video. I've been wanting to make this for a very long time.